right, hi and welcome to the Skeptical Leftist Podcast, the show where I talk to a variety of people to spread critical thinking, progressive politics, and left-wing philosophy. And today I'm joined by Drew Adamick. Thank you for joining me, Drew.
Thanks, Corey.
So, I guess we got to get to know you first. So, who is Drew?
All right, so I'm a financial planner. I have my own independent, what's called fee for advice only practice. So it's a small but growing field of financial planners within Canada. There's about a couple hundred of us out of like 17,000 certified financial planners in the industry in Canada. But what we do as a financial planning practice is we don't sell products. So we don't sell investments. We don't sell insurance. We're not at a bank. We're not at a credit union. Okay. We're not affiliated with we're not an employee or have like a licensing, affiliation with a particular investment firm. We run independent financial planning practices, and we kind of work how like a lawyer or an accountant would, whereas we would bill people based on a project or an hourly basis for, to provide financial plans for our clients. And the main reason we, as a practice, we do that is to mitigate the conflict of interest that's present in the financial services industry regarding compensation. Mm-hmm. Because when you deal with most people at a bank or a credit union or even with an investment firm, they are paid based on selling product. Right. So their ability to put a paycheck, pay their bills, pay their mortgage, all that stuff is based upon either, especially if they're working for a large institution, meeting different sales targets, bringing in assets under management, selling insurance policies, that kind of thing in order to maintain, keep their job basically. Whereas with an advice only practice, we take that out of it because in many cases, we make sure that what we recommend our clients do is as aligned with their best interests as possible and not the best interests of a bank or an insurance company or that kind of thing, right? So It's trying to mitigate that kind of product related conflict of interest, because that's always it's always the challenge when you want to get help for like with budgeting and stuff like that, and things like it's like I'm trying to save money, but the person I'm talking to, they're they got to pay bills too, they got to earn a living too, so and unfortunately the way capitalism is they have to you got to sell stuff. And
right.
I've been in the industry since 2013, started working with RBC as a teller, gradually moved up worked with RBC for a few years, and then I ended up switching to the credit union universe. I worked with a medium-sized credit union in BC for a few years, and then in 2022, I moved to Alberta to work with credit union over here, left them in 2023, and started my own independent practice shortly thereafter.
Okay. So I guess you also are, obviously the show is a leftist show, so you identify as a leftist or a socialist. How does that jive with your financial job?
Well, I like to be able to tell people I'm trying to help you navigate late stage capitalism.
yeah, that's fair. Yeah,
because until the day comes that we have the stateless, classless, moneyless society that we all so want to have, and we need, the planet needs, humanity needs at this point. We still gotta survive in the short term, right? And that's kind of what my job as a financial planner is I help people navigate what they do within the in the short term, help them prepare for the longer term, and help them navigate all the different ways that they can kind of help them get to where they need to go do this. But based upon your circumstances here, it's like where do you work? What's your income level here? Do you have any, what are your expenses? What's your budget? What's your, do you have any dependents kind of thing? What level of savings do you currently have at the moment here? And how do we get, we build a roadmap to help get you to where you go, where you're looking to go, and look at some different contingencies around the way, such as, for example, let's say unexpected job loss, or
right.
Or let's say, for example, if you're a unionized worker and you go on strike, and obviously strike pay doesn't pay the same as your regular salary, basically. So you got to budget and prepare for that as well too there. And but it's often interesting because in the financial planning industry, there's a lot of assumptions that we have. One of the assumptions is that ideally one should have at least 3 to 6 months worth of monthly expenses saved up. But I mean, it's easier said than done, right?
It seems like an alternative universe to me. Like, what the hell
Yes,
is that?
and that's the ideal, but
Right.
we all know, it's much easier said than done, especially with so many people that are living paycheck to paycheck. One missed paycheck can mean you fall behind, and then you get the poverty taxes, which is the NSF fees, getting dinged here and there, and not only NSF fee from your utility bill, but also on the credit card or on the bank account. And it takes sometimes it might take even an entire paycheck just to recover from that.
Yeah, for sure. Yeah, it's. I often think those things should be illegal in themselves. Like that NSF charge. Like, how can you ding me $50 for having no money? Like,
well, there is some good news on that front, though. Unless Carney decides to reverse it, but I know there were plans on, at least for federal regulations, about reducing that fee to $10 starting. I don't know if it's this year or later this year or sometime in 2026. Can't remember off the top of my head, but I do know there is some relief funding potentially in that one. But again, who knows if Carney reverses Trump?
That could potentially save my family hundreds of dollars a year. So that's switching that to $10 instead of $50 is pretty good deal.
And it varies by institution as well too there as well. And the thing too with the way things with the industry is because banking is federally regulated, it honestly doesn't really matter who you end up banking with. You're still dealing with the same regulations,
right?
Pretty much the same regulations on use of that, regardless of whatever institution you go with. So, some people, when I usually tell people, it's like, okay, which institution or which bank should I deal with? And I'm like, whichever one you're most comfortable dealing with, whichever is most convenient for you, and whichever can provide you with the services that you need, as opposed to the services they want to give to you.
Right. I know. I know a lot of people. They're like, my company does like a matching thing with RSPs and TFSAs, so then we have to deal with the bank that they want us to deal with when it comes to that stuff. Yeah. And like, so then you don't always have 100% control over which banks you're going in and out of.
No, you don't. No, yeah. And that's often the challenge when you're dealing with a lot, especially with like for group retirement plans as well too, is because we're increasingly seeing, because fewer and fewer places are offering defined benefit pension plans these days. More often than not, if you do have some sort of retirement plan through your employer, more often than not, it's either a defined contribution pension plan or it's a group RSP, which is they're similar in concepts. The only difference is that if it's actual pension plan, it's governed by pension legislation and stricter pension rules.
Right.
Whereas an RSP is more flexible.
Right.
I use the term flexible in quotation marks because they both pretty much do the same thing at this point, except that the major difference though is if it's an actual pension. Like for example, if you have a spouse, there are spouses have certain right to pensions,
right,
as well as pensions are creditor proof. So if you end up having to declare bankruptcy, or if you declare bankruptcy, pensions are exempt assets,
right,
because they're meant for retirement plans. Whereas a group RSP, they don't have the same type of protections if you had to declare bankruptcy, basically at this point. So
right. I guess at this point we should probably mention that Americans may not get as much out of this.
Yeah, exactly. So, and there is an alphabet acronym soup in the industry when it comes to all these different stuff here. For American viewers that are watching this as well too here, RSPs are roughly an equivalent of a 401k.
Right.
So for any Americans listening into this one here, Canada's like I've dipped my toe in looked at a few cross-border planning stuff, and just the sheer number of different types of investment accounts in the United States, like you've got IRA, Roth IRAs, all this other stuff here. I mean, and we've got a similar number of type plans in Canada too, but it's nowhere near as complex as it is in the United States. I mean, we do have an acronym soup in Canada, but most of the acronyms you see on the various locations are really just variations of locked-in pension plans. It's just because pensions are governed by the jurisdiction where your employer is regulated. So, for example, if you work for a federally regulated industry like railroads or a bank, or if you work in the territories, then your pension is federally regulated.
Right.
Otherwise, your pension is provincially regulated, and it's subject to the different laws. And each province has their own different laws and things like that as well, too, regarding the pensions. And of course, a lot of them have to have the same different acronyms, just because.
Yeah, because we're Alberta, we're Saskatchewan, we got to be different.
Exactly.
Yeah,
and then there's Quebec, which is an entirely different ballgame in and of itself. Basically, when it comes to the financial industry, yes, banking and stuff is federally regulated, but whatever's not federally regulated is provincially, and Quebec pretty much does their own thing. So,
right, yeah.
I like for myself as a financial planner, I'm able to serve clients. If you have a certified financial planner designation, you can serve all clients except in Quebec, because if you're in Quebec, there is an actual course that you have to take.
Right.
And to get registered, and you have to register directly with the provincial government there, which from a regulatory perspective is, Quebec has always been about 5 to 10 years ahead of the curve of the rest of the country.
Okay.
With a lot of regulations and stuff like that too.
Interesting. The
only other province that requires regulations of who can call themselves a financial planner, which is weird because it's like any, unless you've got a designation, any idiot could really call themselves a financial planner, which is, this is something that people in the industry, like we in the industry, have been fighting for, years to try and regulate it, because, and you see this online, like, people, TikTok influencers and things like that, too.
Right.
And it's so challenging because, like, the professionals we're trying to put content out there that actually, one, makes sense, but also, we have regulations and we don't want to mislead people. But then all of a sudden, the finfluencers that they're just there for clicks, follows, and likes and stuff like that too.
Yeah, and their job isn't tied to it, so they don't have the rules against them. But the professional stuff, right, with that too. Yeah, but like I said, the only other province that regulates who can call themselves a financial planner is Ontario. Okay,
but there's a few challenges about that. Is they've kind of so in Ontario you have to have one of a few different designations to call yourself a financial planner. Although some would argue that the way Ontario is regulating it isn't so much actual regulation, is more of a cash grab. But I personally, with the way things are going through, my personal opinion is that it's more towards the latter, because this is also the same province that hasn't completely banned deferred sales charges on mutual funds. Ontario is the only province that still hasn't banned it. But effectively, most places, it's hard to, you can't get any new mutual funds with deferred sales charges anymore because every other province and territory have banned them. So because places want to work, want to have work across Canada, it just makes sense where it's like, whatever, we'll just, it's just easier for compliance to just be like, whatever, we'll just not offer them, period. So, but yeah, I mean, but that's the Doug Ford government for you, right? So,
right.
But
I know, I used to do a Saskatchewan news podcast with a friend of mine who worked in the financial industry. And I know that he was always very careful about what he said about finances, or didn't want to cross any lines, didn't want to give any advice. He absolutely could never give any advice on the show.
Yeah, that's one of the things there. So, well, and maybe on that one, I'll probably provide my disclaimer caveat. So anything I'm saying is my personal opinion.
Right.
And it's not a professional opinion. It's not advice. It doesn't constitute setting a planner-client relationship. You only have a planner-client relationship with me if we actually sign a letter of engagement.
Right.
And which basically means I officially take you on as a client. And any financial planner or advisor worth their salt should be doing that. If they're not, run, don't walk away.
Right. Yeah. So anything that's said here, if you follow what you say, you can't be held responsible.
Exactly. Yeah. And it's always been the thing, even in the past, because back when I was securities licensed and insurance licensed a little too, but mostly securities licensed, was every social media post, every public, mass client communicate, we had to get it has to be approved by the compliance department. It's mostly to make sure of, securities securities mutual funds are offered by this particular investment dealer. Past perform, it's the usual legal. It's the legalese saying it's not an offer to buy securities or mutual funds. Past performance is on a guarantee future returns. Read the prospectus. Read the fund facts. Everything. Basically, it's the compliance stuff. Yeah. But again, that often goes to show you it's like why professionals trying to educate people. This is the added stuff people have to go through. Versus again, you get the finfluencers that just. And be like, oh, here's a hot tip.
Buy this meme stock.
Exactly. So, I mean, I'm in my practice because I don't sell product. I don't have to worry about insurance licensing and securities license. The only caveat with those is I can't tell people buy this stock or don't buy this stock. Basically, I just anything I do talk about, like on the wealth on the investment management side of things, on the insurance side of things, is just more general. It's mostly of like for investments, like here's what a target asset allocation should be, which is basically here's what portion of your investments in theory should be in stocks, here's in bonds, here's in cash.
Okay.
But I leave it up to you to decide what,
where you actually direct
where you want to go with it. Because I also know, especially for many leftists as well too, there for and socialists as well, like when you're trying to use your money to work towards investments in a portfolio that's aligned with your values, it is
complicated.
That would be an understatement. I'm not going to say it's impossible, but it is incredibly difficult.
Yeah.
Because the challenge is because the investment landscape in Canada is so concentrated, and in many cases, this is industry. I'm not going to say dogma, but it's maybe one or two steps below dogma, but the general but a relative consensus in the industry is that index investing, passive investing is lower cost and is more efficient, quote unquote, active management. But the challenge when you buy an index fund is you're buying every company within that index, the good, the bad, and the ugly. So for example, let's say for example, you want to exclude anything related to oil and gas, as for example, like the so-called responsible investments,
right?
Which I could go on a tangent, green capitalism and things like that, right?
For sure.
But let's put it this way: when you buy an index, you're buying every company within the index, so you don't exclude. Yeah. Now, in theory, if you go into active management, in theory, a portfolio manager is supposed to be doing that for you, but most of the time they're just closet indexers, and they're charging, and you're paying anywhere between 5 to 10 times, if not more, as much.
Right. For essentially the same thing. Yeah.
For essentially the same thing at this point here. But again, a lot of the challenges, especially like if you're trying to, the only way you can guarantee trying to eliminate specific companies from, for most average Canadians, because the retail investment landscape is just, sure, you can get into a mutual fund for for a few $100 initially, or buy an ETF as well too there for whatever, as long as you got the money to be able to buy the units plus whatever commission is applicable, depending on the platform that you use. But again, you still don't have any control over the companies that are inside that. It's either, if it's, like I said, it's an index fund, you're buying every company in the index. If it's an actively managed one, you're trusting that the portfolio manager is doing the job. But if you don't trust that, if you want to make sure for that, the only way to do it is to buy individual securities. Right. But from a risk management perspective, unless your risk tolerance is high, if you do, the general rule of thumb is when I was in the industry, is to really start getting at individual securities to mitigate risk, you need at least 6 figures. Otherwise, the risk just goes up, because it's the whole putting your egg in one. It's like putting your eggs in one basket. If the basket falls out, then
That's
then
right.
that goes to this point. So for a lot of people to do that, I mean, it's possible, but you have to be cognizant and willing to accept that risk.
For sure.
And a lot of times, and it's been interesting in my career, a lot of the people that are looking for that typically don't want to have that risk. It's, the whole thing is like, oh, it's like, I want 5% per year, no risk. And I want to tell you, there's no such thing.
Yeah. Well, and you saw that like pretty clearly at the start of this year when Trump started doing his tariff stuff, right? Like, because you could have your money, like I have a lira from my old job.
Yeah.
And it dropped like over like a course of 2 months. Like I think it went down like $10,000 or something. I'm like,
you wouldn't be surprised with the way things are going at this point, with the way the markets are at this point here. And
it's pretty volatile. Yeah.
It's volatile as well too there. But what I've always like, but back, here's the rule of thumb when it comes to, if you have, stuff invested, if you don't need your money within 3 years, just don't touch it, and don't touch it.
Don't look at it.
Well, I won't say don't look at it, because you should be looking at your statements. Everyone should be looking at their statements, right? Because you got to make sure nothing crazy is happening. But again, if it's a short-term correction, like corrections happen all the time, and typically on average they happen on average every 7 years or so. There's usually some sort of major minor downturn. In other words, like a correction is like anywhere between 10 to 30%. There's usually a dip in the market,
right?
Roughly every 7 years.
Okay.
If you look back, like if you look at the trends, like if you go into a lot of like banker offices, they'll often have this big, we call it the index chart.
Okay.
And it goes back to like 1950. And it tells people like, okay, here's what different asset classes, if you start with like $100 in 1950, here's what it's worth, in the year the chart was made, right? And it tells you the inflation rate over that period, what the prevailing interest rates were, who was the president, who was the prime minister in power at that point. And it kind of gives you a bit of a, tells people kind of, in one pictograph, here is what money can do over the long period. And if you back on it, again, downturns happen, but if you need money in a short-term period anyways, you shouldn't even be investing in the market anyways, because the risk of like I said, a 10% downturn happening, like if, let's say, for example, if you're trying to buy a home in a few years and you need that money for a down payment, do you want to risk losing 10% in a short-term period and not having it recover in time?
Right.
When you need a down payment? Yeah. If your time horizon is what we call it is shorter, you want to be lower risk. And typically speaking, you want the minimal amount of risk possible if your time horizon is like 3 years or less. But I'm not saying no risk, because here is something that I'm going to say that is against a lot of industry dogma. There is no risk investments, but there truly is. You truly cannot eliminate risk from any
right.
Because you're dealing with money. There is always going to be a risk with fiat currency. There's a risk for everything, even GICs have risk.
Right.
And here is a truth that is one of those truths that people don't want to hear when it comes to savings. GICs are not that guaranteed.
Okay.
And so what I was saying is here, so a truth that people don't necessarily want to hear when it comes to savings and personal finance. GICs are not all that guaranteed. And part of the reason for that is the guarantee that a GIC offers is a gross guarantee. So, for example, if you go to a bank or a credit union and they offer you a GIC, let's say they offer 4%.
Sure,
that's a gross guarantee. So, in other words, they'll pay you your principal, and depending upon the institution, the principal is covered by deposit insurance, which, depending if it's a federally regulated institution, they only guarantee it up to $100,000. If it's a provincially regulated, like a credit union, for example, it varies by province. Ontario, for example, only guarantees $250,000. Currently, Alberta, BC, and Saskatchewan is unlimited, but that could be subject to change if the governments there decide to do so. But in terms of the return is only a gross guarantee. And so gross as in before inflation and tax.
Right.
And that's always been a challenge. This was always a challenge, especially back in the pre-early pandemic phases. Pre-2022, I should say, because after 2008, between 2008 and 2020, arguably 2022, we had one of the 15 years of one of the lowest interest rate environments in modern history. Basically, you'd be lucky to get, in many cases, 2% on a GIC.
Right.
And the average rate of inflation that the Bank of Canada wants to target is 2%. So let's put it this way: if the rate of inflation is higher than what the GIC is, you are technically losing money.
Yeah, that's right.
You don't see it. You don't see it because inflation.
Yeah.
People don't see how
it's like invisible. Yeah.
It's an invisible loss. Whereas that's always the challenge when you deal with an investment portfolio, is because it goes down. It's more
right
to a degree. Ironically, it's more transparent. And also, again, with the GIC, depending upon the type of account it is, it could be subject to taxes. So if it's in a non-registered account, you have to pay taxes on the interest every year for it.
Mm-hmm.
And the way our tax code works is that it penalizes savers versus people investing in corporations, because interest is treated like employment income.
Yeah.
Whereas if you have a stock, unless it's in a registered account, it's subject, you got capital gains, but our capital gains rates, when you factor in, only 50% is currently included in the inclusion rate. Capital gains rates are typically lower on average. And then of course we have with dividends, there's preferential tax treatment especially for certain, what we call eligible dividends, which is
right.
Canadian companies. You get preferential tax treatment on that. That also explains why a lot of people like doctors, lawyers, even real estate agents pay themselves in dividends. They incorporate their business, pay themselves in dividends as opposed to a salary.
Right.
It's meant to reduce the amount of income, especially like when you're dealing with a doctor. You're making $250,000+ per year. Obviously, they're trying to, and especially if you're a brand new doctor, you're graduating with that much in medical debt.
That's right.
Also, it's always that as well too there. But again, back on the savings, taxes eroded as well too. There basically is, in order to, GIC, in order to have still be, positive at the end of the day with the GIC, your net rate of return, which is your rate of return minus inflation and applicable taxes, has to be higher than, it has to be higher than that calculation. And that varies for different individuals, because, if you're a lower income person, sure, your effective tax rate's going to be, not going to be that much.
Right.
But if you're a high income earner, or if you've got a lot of savings and investments that earn interest adds up.
Yeah.
But sometimes that can penalize people in the lowest, in some of the lower incomes, because unfortunately the clawback for the guaranteed income supplement, which is, for those that don't know, going into a bit of pension stuff, because there's two different types of government pensions in Canada. There's CPP, except Quebec, there's QPP in Quebec, right. Pension plan. CPP is funded from employer and employee contributions. So that's a separate pot of money. CPP is one of the more well-managed pension funds on the planet.
Right.
So people say, "What is CPP going to be there?" Unless Danielle Smith decides to, unless she gets through the shenanigans here in Alberta with trying to, take a portion of the CPP for an Alberta pension plan. If CPP is very well managed, I'm confident CPP will be there. Like, I'm in my mid-30s.
Okay.
I'm confident that CPP will be there, barring the socialist revolution, of course, but let's just say if the status quo ends up prevailing,
right,
he's going to be there. That's funded from our own contributions. That's the payroll tax.
Yeah.
Old age security, on the other hand, comes from general federal tax revenue. Old age security is the pension plan that's been around for longer, and that's automatically given to Canadians, regardless, based upon, years that you've been resident in the country. So, the clock starts as soon as you turn 18, and then the earliest you can take OAS is at 65. And if you've lived in Canada for that entire period, you get the full old age security. However, if your total income is below a certain threshold, I can't remember off the top of my head, it's around 18 or 19,000. It's not that much, sadly. You get what's called the guaranteed income supplement, which is basically a top up if you're basically below poverty that the federal government gives. But with old age security, if your income gets above a certain amount, about $79,000, $80,000, the government starts to claw that back because the logic is, oh, at that money, you don't need additional money. And that, there begins a gradual clawback. And then at around 125,000, they adjust it for inflation every year, but roughly around $120,000 to $125,000 is when, if you get old age security, you have to, any amount that you got, you have to repay back, because the government is, if you're earning six figures, you don't need additional pensions from the government. So,
they don't know what it actually takes to live anymore, do they?
I know, right? That's the logic anyways. But a lot of the challenges is for people on the guaranteed income supplement side is because the threshold for GIS is so low, and you also, there is a GIS, people can be, I have seen cases where either a one-time windfall or a one-time, investment adjustment, capital gain, or a larger than usual, interest on their savings has resulted in people in poverty getting their GIS clawed back or given them into the following year. And when you're giving people working paycheck to paycheck on very low income, like for example, usually if someone's on GIS, they're usually only earning CPP and GIS, which is, you're lucky to maybe make roughly 1,500 a year. A year per month.
It's not very much.
It's not much because the government pensions they're not designed to be the entire source of money that people live on.
Yeah, that's right. Like if you weren't privileged enough to have a savings built up before you retire, then you're not gonna. You're gonna have to work after your retirement.
and that's one of the things I've seen too, is when I'm doing retirement planning with people is, I ask them, because traditional retirement for most people, it's like the whole, you still get the people that do the traditional retirement, or I want to retire early at 60 and I want to do all the vacations and all the other travel and fun stuff. And it's like, well, okay, let's run the numbers and see what you want to do. Let's see what we can do on that one here. But for a lot of people, like, especially if they're still retiring they've still got a mortgage or large or huge rent that they're still paying. Once they hit 65, it's a case of, okay, what can we do to further do things? You can defer CPP until 70. And a lot of times if you're expected to live longer, and especially if you've got a family history of living longer, it usually can make sense to defer, because if you defer until 70, you get a higher payout.
Right.
Whereas if you can take it as early as 60, but if you take it at 60, you get a reduced payout. But you get that payout for the rest of your life.
Right.
The key phrase being the rest of your life.
I
bring my late mother up as an example when it comes to CPP. She retired at 61, took her CPP and her pension at 61, and with it, not even a year after she retired, she died from cancer. So all of that money that had gone into the pensions over the years, and here's the thing as well too, there are a lot of pension plans don't provide benefits for non-spouses. Usually the benefits are there for like dependent children,
right?
Or if there is like a death benefit, it's not the same amount. The death benefit you get from CPP is $2,500,
right?
Which is barely enough to cover like funeral.
It won't. If you have like an actual service with a casket and stuff, I'm sure that wouldn't cover it.
No, that would maybe be what, 20%. Maybe. Exactly. Like funeral services are very expensive, and unfortunately, they can be a case where people can get taken advantage of because it's an emotional time. It's just like, it's often like when you get married, as soon as the word wedding is introduced, all of a sudden the prices jump up two to 3 times. Because it has to. Everyone wants it, because people take advantage of the emotion around, I want it to be the special day. You're taking advantage of people's emotions on that to make money. Again, welcome to capitalism.
Welcome to capitalism.
But a lot of pension plans, again, don't provide full benefits to
Right.
The only major benefits really accrued is if you're married. And if you have have a common law spouse as well too, and then there's survivor benefits as well. So that's but there is a degree of heteronormativity in the way
Of course,
property rights work, because a lot of what property rights, like inheritance laws and stuff like that, a lot of what is going on, and it varies by province, but a lot of the rules are there. They are based on the assumption of a cisgender heterosexual couple,
right?
Traditionally, where the cis man is the one making the breadwinner, and the cis woman is the homemaker.
Yeah,
and a lot of the laws regarding property rights and divisions are there. A lot of them are there. It's there in many cases to protect the, most cases women from, respectively, because they haven't earned the income, their labor was unpaid,
right,
and everything like that too. So a lot of the property division right is there to compensate people for that as well too. But there's still that heteronormativity built into it at this point here, right? Because there's certain property like inheritance laws, property law, family law, and a lot of stuff like that. There does have some of those underlying assumptions. Like, for example, here in Alberta, I had to sell my home recently because I was, for various reasons. Actually, funny thing enough, I'm actually going to be moving to BC in a couple of weeks.
Okay.
So I'm done with this province. For the time being at this point here. But part of it's just the whole COVID, paying for the vaccine, but also having to pre-register just for the potential. There's no guarantee that you'll even get one. So I'm like, I'm going back to BC. I'm originally from BC anyway, so it's like I'll go back to BC. But when I sold my place, because in Alberta they have what's called dower rights, or like dower stuff like that as well too. They're basically, it's the idea, the concept behind it is, let's say for example, you sell a property, you sell real estate, you're the only person on title. But if you're married, your spouse has an ownership interest in it too. And the spouse has to sign off on the property transfer, just to make sure that this, one spouse isn't hiding anything from the other. And that way to make sure that the spouse's property rights in the marriage are protected as well too there.
Fair enough.
It wouldn't be fair enough, but it's interesting. It's still called dower. Yeah. Which has that, that
pretty old,
very old school mentality on it with it at this point here. So, and it was interesting because like when I was at the lawyer's office signing the closing documents, it's like, are you married? I'm like, no, I've, no spouse. So they're like, okay, this doesn't apply to you then. So, right. But again, it's a lot of, that's that's a lot of the things that we do as financial planners. Too, we have to, we look at, how assets are distributed. Like if you're in a marriage or common law relation or a marriage-like relationship, how does that influence everything? Yeah. Especially in the case, and then especially gets complicated in the case of someone's divorce as well too there, because you got to maintain a degree of, objectivity. But sometimes it might come to the point was, okay, if your clients are divorced, if you got a married couple as clients, if they're divorcing, you're going to have, really as a planner from an ethics perspective, you're going to have to pick one to stick with. Right. Because if they divorce, they now have material differences. You're in a conflict of interest if you're serving both, because you have to, provide for your client's best interest as possible. But if their interests are now colliding, exactly, we got to pick one or the other. Yeah. So that's often a lot of the challenges that, we, from an ethics perspective that we have as, being financial planners, is who do we stick with? For sure. Who do we manage? How do we manage, how do we manage relationships like that? Property divisions. It's, being a financial planner isn't, it's not only staying up to date with, trends in the financial industry and stuff like that, but it's also almost being like one part relationship counselor or like one part therapist. Basically. Because unfortunately, with the way our system, because the system forces us to have money to live. Yeah. And ways of managing it. And that's kind of what, as a financial planner, it's like, we're helping people manage their money. In other words, helping them manage how they live or are able to live, basically. Right. So, it's, and I find like, because if it's just straightforward stuff, like I can usually keep track of things pretty well, mathematically, all these various, but there's all these other rules and
influences in
Yep.
the rules and regulations and the way that certain people have to act and certain companies have to act, and you
Yep.
go like, so now it makes no sense to me, and I'm
And a
supposed to
lot of
fucking
it's
make a
deliberate.
decision.
Yeah, and a lot of it, and a lot of it is there to legal jargon. I mean, laws are there, but we all know laws are there for a reason, and they're
Yeah.
we all know that, they're generally not there for most everyday people at this point here.
Yeah,
They're there
that's right.
there's a although like with there's liability and all that other stuff as well too there. But then of course then there's the fun stuff, is the estate planning stuff, and oh my goodness, when someone passes away, you can imagine that, again, because we need money to survive, you can imagine how many people's personalities can do a 180.
Yeah.
As soon as they're like, oh, I can get an inheritance, I want it yesterday. Doesn't work like that.
Yeah, I know, even from my own experience, like families that are generally pretty close, when say your grandparents are still alive, they rip each other apart when one or both of them pass, and it's like over money, like, and
yep.
I mean, that's
over money or over
property, I guess, or
property, or even just like who gets grandma's china.
Right. Yeah, that's right.
Who gets grandma's china, or who get grandpa's stamp collection.
Yeah, it's pretty wild.
And that's always the thing too, is that sometimes it's like it's just, especially when you look like with division of property and things like that as well too there. And this is why I always advise people, especially for the queer community out there at this point, because intestacy laws, which is laws in each province that govern what happens to who gets your stuff if you die without a will.
Right.
It typically favors family members, and if you're not on good terms with your family, and this applies to everyone as well too there, if you're not on good terms with your extended like with your blood family, get a will.
Yeah,
that's probably the important thing. Is because here's the thing: if you don't have a will, the government decides by legislation who gets your stuff, and the government's priorities are making sure that any spouses that your spouse has their property rights, interests, and their monetary interests are protected, and then any minor children that you have, their interests are protected.
Right.
Or at least let's put it this way. Not so much protected, but they're supposed to get something. Let's put it this way. So let's say, for example, but again, every province has their own different laws of various sort of. In Alberta, it's called it's the Wills and Succession Act here in Alberta.
Okay.
But basically, each province has their own law that basically says if you die without a will, here is the order in which who gets your stuff.
Right.
Who gets your assets, your stuff as well too. They're not just physical stuff, digital assets are an increasingly important stuff. So people have like, let's say you're a gamer, you've got your Steam account or your Nintendo account. Who gets access to all that, right? So there's all this other, so I always advise people, get a will, because at least, something happens, you've got a document that basically says, here's who I want to get my stuff. Name 2 trusted people. You always want to have a backup. 2 trusted people that you can trust to manage your affairs. Ideally, if you know there's going to be some family dynamics, to be polite, you might want to consider having someone outside of the family do it, just to make sure that there's no drama or bad blood kind of thing at this point here. Every dynamic is unique. You always want to have 2 people that you can choose, because you always want to have a backup.
Yeah.
In case one decides, I don't want to touch this, because being an executor is not an honor; it's a burden.
Yeah.
It's thankfully in Canada, dealing with estates is nowhere near as stressful as it is in the United States, but there's still issues at this. There's still a lot of issues at this point here, and oftentimes when estate planning happens, the biggest question I'm asked is, how do I avoid probate? And I'm like, why do you want to avoid probate? People get into more problems trying to avoid probate. It is here. Right. So basically, for everyone listening, all probate basically is your provincial, or in this case, if you're in the United States, the state government basically putting their stamp on your will, saying, this is your will. We validated that this is the will. This is what's going to happen. And you're paying the fee for the privilege.
Right.
In Alberta, that fee the court fee for that one is $525.
It's enough.
In British Columbia, though, it is on the value of the estate, on the value of the estate above $500, it's 1.4% of the value of the estate.
Really?
So a lot of the reason why people ask me for a lot of for probate, how to avoid it, is because in provinces like, for example, Ontario, Nova Scotia, and BC, they don't charge a flat fee. They charge a percentage of the value of the estate. And when you've got people like, for example, in Vancouver and Toronto with their home is $1 or $2 million,
they don't want to pay that. Yeah.
Yeah, they don't want to pay that. And if you own real estate, you need probate, because the land titles office will not transfer out the title without probate. That's unavoidable. So people try and do whatever they can to avoid. They're like, I want to avoid probate. I want it to be clean and everything. I'm like,
right.
We're going to cause more problems than not, because again, challenges is that if you avoid probate, I'll just add my adult child on title with me at this point here, and I'm like, you've just opened up a huge can of worms.
Right.
You think you're saving money in the long run by doing it, but in reality, what you've just done is you've just done a deemed disposition of your house at that point at fair market value. Unless your adult child is living with you as their principal residence in that house, their half of that one is now subject to capital gains, because you've just done a disposition. Let's say that place is worth $1 million, and let's say 5 years later it's worth $1.2 million. Your adult child now has a $100,000 capital gain.
Right, that they have to pay taxes on, that they no longer...
If they're married and if they go through a divorce...
Right, now their ex has claim on that, yeah.
They have, it might be hard to get it, but you're going to have to pay your lawyers a pretty penny to fight those interests as well, too, there. Or if they declare bankruptcy, if your adult child declares bankruptcy, they can go after the assets. People really need to think before they make decisions at this point here. Mind you, half of those problems could be solved if you could just name a beneficiary on real estate. But you can't do that. And there's no way governments are going to do that, because that would mean they would lose out on the revenue from probate here. Because here's the thing as well, too, that people talk about death taxes. The federal government, all the federal government does tax-wise, as much as bitching about the federal government is a very popular pastime.
Right.
And not entirely, not unjustified.
Right.
The only tax that you have to pay to the federal government for most average Canadians is your final income taxes. Because when you pass away, basically you are deemed to have sold all of your stuff at fair market value, unless you've got a spouse, in which case it rolls over to them, generally speaking. But let's say, for example, you are deemed to have died. You're deemed to have sold all of your assets at fair market value the moment you pass away. And if you have any, and that includes your RSPs, which includes you are deemed to have sold them and converted them to cash the moment you die, unless there's a spousal rollover or something like that, or various other provisions. And that's where a lot of times the final income taxes can be a bit of a bitter pill to swallow in many cases, because you're deemed to have sold all of your assets. But basically, all CRA cares about is, okay, tell us what is sold here. Pay the final income tax bill. Once you've done that, you apply for something what's called the clearance certificate. And then once that's done, CRA is like, we are done with you for the period. So
it's weird, because so to my ears, a lot of this sounds like a huge pain in the ass, and I don't want to have to deal with the government, and I don't want to have to deal with all this shit. I mean, luckily I don't have any property, but you've got
RSPs, and often the challenge is, and for most working people, it's like you've got little things like that. But again, it's like the system. You do need a help. Like in many cases, you do need a helping hand to get through the system at this point here. I mean, when my mother passed away, I was fortunate enough to, the lawyer's fees was more than the probate fees. But let's put it this way. I didn't. But at least let's put it this way. I was paying the lawyer to take care of all of that stuff here, so I didn't have to worry about it.
Right.
Yeah, and all that stuff. I still had to file all the final tax returns, but fortunately, but again, I had experience working in the industry, so I was able to leverage resources available at the time to help me with that. And most Canadians don't, so that's why it is important to talk about these things with a financial planner to be like, okay, how can we plan for all of this here? How do we get everything set up? How do we take care of all this here? What do we do? It's just to make things as easy as possible here, or as not as easy as, relatively easy, because it's still difficult dealing with,
because like you say, like there's the people with the resources, they don't have to worry as much about it, but then they're also the ones that are often fighting these things the most.
They're fighting it the most, because in many cases they have the most to lose because of the liabilities involved, but they also have the resources to hire, the resources to fight back.
Yeah.
Whereas with, you and me and everyday people, like, we have to, what little we might have available, again, because it's like when you're, paying a lawyer, anywhere, $2,500 to $3,000 is no small, that's no small chunk of change for people.
Right.
Like, that's still,
for sure.
But sometimes, in the vast majority of cases, I always say, if you're an executor, if you can, start saving up money for a lawyer, to have a lawyer on retainer for you, just in case that happens as well too there, just because it's, less of a headache for you to deal with at this point. Right. So, but again, you want to have a solid again, it's the thing with benefits of work with a financial planner, especially the estate planning. How do we make sure that your affairs are as relatively easy to tidy up as possible? Because unfortunately, things like your debts don't automatically go away when you die. They're still there. And they still have to be taken care of, sadly. And just dealing with that,
fucking leeches, man.
I know, right? It's ridiculous. But again, you want to have a good plan, and you need to have a good plan in place. And that's one of the things when you work with a financial planner, because when we have 6 key areas that we work with, we've got, we help with what I call it cash flow planning, which is basically budgeting, basically helping you navigate late stage capitalism today.
Right.
Retirement planning, helping you navigate late stage capitalism in the future when you're older and you're not able to, your ability to earn an income or to labor for income is not there because of either poor health or age or just in general, or maybe you're just like, screw it, I'm done, I don't want to work anymore. So we plan for that. And then the investment planning is, okay, how do we help build a savings to help get you so that you can achieve the things you want to do when you're older? Then there's the risk management, which is what we say to avoid saying the word insurance, because insurance is a 4-letter word, but but there is some certain benefits of having, insurance can be useful in certain circumstances. Often the reason people take out life insurance policies is because they want to have a lump sum of cash if something happens to them. Like, for example, most people, if they are parents and if they got children, they want to have a life insurance policy so to provide a lump sum so that the kids can go to school at the end of the day, or the kid, the mortgage can be paid off so they don't have to sell the house, or they, there's a lump sum of cash that they can use to help pay the bills until they're old enough to, go to school, and get it, start earning income on their own kind of thing and provide stuff. Or if they're older, to help pay the taxes at the end of the day, if you still get a large bill to pay here. Then there's disability income, although that's harder and harder to get these days here.
Yeah.
But basically, like, if you're disabled, how to replace your income if you're disabled. Critical illness insurance, which is, let's say you get cancer or heart attack, how do you deal with the expenses? Get a lump sum of cash to help deal with some of those expenses and things like that. Yes, insurance is a challenge. We all know insurance companies very much do not want to part with their money at this point here. But there can be some benefits to looking at it. And again, for most people, for most working people, most of their experience with a life insurance plan is, typically speaking, if you've got a group benefits plan at work, you typically have a group life insurance policy, even if it's not that much, which is, it's there and it can helpful, although it's only there for as long as you're working with the company.
Right.
So that's the only thing to there. Typically, when you leave, if you leave a company, you usually leave your benefits behind with it, unless there's some sort of carry. Unless they can give you the option for, to continue on with some benefits out of your own pocket, of course. But again, a lot of that, there are some, some conversion benefits as well too there. But typically speaking, if you're, if you've got to, like I say, for most people, especially, if they got, group retirement benefits, there's usually some sort of group medical, like if you've got group medical and dental benefits for work, you typically have a group life insurance policy as well too there. But also risk management as well too. There's medical and dental insurance. Also dealing with properties insurance, because if you own, like even if you rent, you should still have tenants insurance, because it covers loss in case of, let's say, a fire happens or a flood happens or something like that as well too. They're based upon the policy. Again, generalized stuff, I know, but again, it's help replace your contents if you lose your stuff due to due to an event, or but in many cases it's liability coverage. So let's say, most tenant and home coverage gives you personal liability coverage to help you in case of like you're liable for like damage, like like if somebody gets injured on your kind of thing, right? That kind of thing. Car insurance as well too there. If you got a car and things like that too, right? So it's just making sure that the insurance you got works for what you need. There's versus the insurance that you have to have based on, like, if you got a car, you have to have insurance. Yeah. At least let's put it this way: you're legally required to have insurance.
That's right. And you do get in trouble if you don't have it.
You do get in trouble. You will get in trouble from the government if you don't have it.
Yeah.
Things like that. And then there's the tax, and then the other part is the tax planning. And so it's okay. And how I like to measure it is basically, it's like for some leftists, it's like, yes, taxes are the price we pay to have all the fun stuff. But of course, we all know governments don't spend it on the stuff we want it to spend.
Right. That's right.
But tax planning is usually I usually leverage is paying what you're supposed to be paying to the government, and finding ways, if you want to reduce the amount that you want to pay in taxes, how can we? What legal ways there are for reducing it as well too there, because there's tax avoidance and there's legitimate tax avoidance, and then there's tax evasion.
Yes.
Tax avoidance is mostly what legal ways can we do to reduce the taxes that we owe, and for certain things, the government even has tax credits and deductions that allow you to do that.
For sure,
the government incentives. This is like RSP contributions is one of those things as well, too, right? If you have a disability, apply for the disability tax credit, and if you're on AISH in Alberta, you're now forced to. Thank you, Danielle Smith.
Right.
But if you have the federal disability tax credit, that's an additional benefit that you get from the federal government, and from that, there's now that new federal disability Canada disability benefit where you can get up to $200 from the federal government,
right,
in additional income if you're disabled, except if you're in Alberta, they're clawing that back. Among the reasons I'm leaving, among various reasons I'm leaving for the time being, but again, like, there's benefits available to that. Like, there are legitimate reasons you can use to reduce reduce the amount of tax that you owe, and the government lets you do that. That's allowed. That's there's tax of then there's tax evasion, which is against the law. Because basically it's like you owe this taxes, but you're not paying it.
Right.
That's when governments don't like it at this point as well too. There.
Yeah.
So and it's even it's for most average Canadians, the only if you're a T4 salaried employee, unless you've got a lot of deductions that you got to make for like medical expenses or the disability tax benefit or various other stuff, your taxes are deducted off of your paycheck anyways. And chances are most people on a T4 income generally, there might be some issues, but it's not much to worry about. Usually if you're self-employed like me as a sole proprietor, that's where things get a little bit more
complicated.
Get more complicated. Or I've seen it for people that are retired, because when you retire, you all of a sudden go from one income source from your paycheck to multiple sources, because you got the pension, government pensions. If you're lucky, you've got your own your employer pensions. Then you got your own savings. They don't communicate with each other.
Yeah.
So I've seen so many cases of people that have just retired, and the year after they retire, they file their tax return, and I owe taxes? Why? Because they're not deducting enough off your paychecks, because your pension is not talking to CPP, which is not talking to your RSP provider. You have to do that. You have to ultimately do that math for you. And that's where a financial planner can help with that.
Yeah. No, I know me and my partner, we have a kind of a financial advisor that we go to. And I mean, it's not like we have a bunch of money, but we go in and they help us with a variety of things. And that's why we have, like, I have a life insurance policy. That's why I have it's just $50 every 2 weeks into a personal RSP, but but it's something that's going away. It
adds up. It adds up as well too at this point here. Although, RSPs, they can be a useful tool. However, I do have to tell people there is a Faustian bargain with them.
Yes.
The general rule of thumb with an RSP for most people to understand is the government owns the government owns 1/3 of your RSP is the rule of thumb.
Yeah, that's right.
And the reason for that is that's typically what they will take from the RSP in tax liability, because basically all RSPs are is tax deferring. You're getting a tax credit. You're getting a tax credit now for contributing to it, but you got to pay later when you pull the money out of it.
Yes.
While it's within the plan, it's exempt from taxes on an annual basis. So it grows tax-free while it's still in the account. Or still within an RSP. The moment you do a withdrawal, it's taxable income. You get a T for it. So, and the reason I say, 1/3 is because typically that's usually what, on average, what it is. Now, sometimes you can get it less if you time your RSP withdrawals and your withdrawals in retirement accordingly.
Right.
And as soon as and in the year after you turn 71, you have to take it out. You're required to take a minimum amount out every year, riffing it. There's different rules behind that. So there's kind of all that at this point here. So that's why I say there's a bit of a Faustian bargain. Now, the tool can work for some people. It may not necessarily work for others. And that's why it's important to sit down with an advisor and a financial planner to look at your situation, because depending upon your circumstances, other savings plans could be a benefit. That's why we now have the tax-free savings account, which, as much as it's weird, because as much as the Harper government, as much as there's so much to criticize about the Harper government, the Harper government, particularly the late Jim Flaherty, brought in 2 registered savings plans, one of which I personally am very glad that they brought in. The one that people are most well known was the tax-free savings account. That was brought in 2009. Right. So TFSA is basically, you contribute to it. You don't get a tax credit for it, but the money grown within it is tax-free, and the withdrawals are tax-free. However, you got to be careful on how you use it, because too many people treat it like a basic savings account, and CRA doesn't.
But every time you deposit it, it counts against your total.
And now the amount that you withdraw, you can get that contribution room back the following calendar year.
Right.
You have to wait. People don't wait. That's half the problem.
Yeah.
And TFSAs are also exempt because they're tax-free exempt. They're exempt from so if you're on old age security, GIS, you don't have to worry about clawbacks if you pull money out of your taxed-free savings account, because it's not taxable income. It doesn't count to your taxable income. So there's some benefits there. But the other thing they brought into then, if you're disabled, and if you have the federal disability tax credit benefit, the government there, they brought in the RDSP in 2008.
Okay.
Disability savings plan. It works similar to how the RESPs work in terms of when you put money into it, the government gives you a matching amount.
Right.
So, for example, if you put in 15, based upon your income, but roughly speaking, for most working Canadians, if you put $1,500 in an RDSP, the government contributes $3,500, and that's before you invest it.
Right.
There's up to $90,000 in government money available if you have a disability to help save for your long-term retirement as well too there. So if you're eligible, my advice to anyone who is disabled, if you're on provincial disability, regardless of whatever province that you're in, if you are not eligible for if you are not already claiming the disability tax credit, apply for it. Yes, you might have to pay some money out of pocket for your doctor to fill the paperwork out. And unfortunately, but if you can get that filled out and get approved for the disability tax credit, you can get the RDSP. And there's so many benefits with that available. Again, there's money from the government available to help you for your older age, basically at this point.
Right.
RDSPs were actually brought in as a result of years of advocacy by the I think, if I remember correctly, it was from the Down syndrome community.
Okay.
Because they were looking for ways to help people, to help them save for retirement, because one of the challenges for those who are disabled is their ability to earn an income and benefit from RSPs and pensions is limited, because they typically don't, if they typically either can't get much work, or if they do get work, it's the income is their ability to earn an income is significantly reduced.
Yeah.
The RDSP is designed as a way to help them accommodate that to there, but anyone with the disability tax credit is eligible for it. And any Canadian watching this, if you have the disability tax credit and you do not already have an RDSP, open one up. And a great resource to go to is from the Plan Institute out of Vancouver, Greater Vancouver. They have called rdsp.com. Lots of resources available for you to check out as well too. There, if you're also a BC resident, they might even have an additional grant available for it.
Oh wow!
Too. So take advantage of that. There's a lot of great resources available to there, and that's all. And publicly available resources, all for free on the for free on the website. Take advantage of that
for sure.
And, yeah, it's again, there are so many different ways to help save for your old age in this one here. But again, it's
save. I'll just work till the day I drop. That's all.
or save if they can. But here's the thing too with the RDSP as well too. There, the Canada Disability Savings Bond, which is one of the two components of it, you don't have to be contributing to it to get the money from that one. The government will just, so there is a lower income component to it as well too. So, which is up to 20,000 of that 90,000 is the bond portion. So they pay it up to about 1,000 a year, basically. So they don't give you the whole amount all at once, obviously, but it is. But if you take advantage of the matching amounts over a period of time, there's some great benefits to play there. And I didn't even know. Like I'm autistic. I was diagnosed on the autism spectrum 2001. Okay. And that was when my mother at the time applied for the disability tax credit I was fortunate the fact that my mother applied for the disability tax credit on my behalf to help benefit her taxes back in the early 2000s. So I had that benefit, and that's permanent for me. But I didn't know that, even though the RDSP was introduced around 2008, I didn't even know that this plan existed until 2013 when I started working in the industry. I did not know. The government did not do a good job of promoting it much as well too. They're doing a better job now because they do send a letter out every year to those who have the disability tax credit saying, did you know you could also benefit from this too? So to try and get more people to take up on it. But there's unfortunately though, if you're looking for RDSPs, they are not as ubiquitous as our RSPs and TFSAs.
Right.
And you got to be careful about which institution you go with because you can be limited in product offerings with it. I know in my experience, like if you go to a retail bank, like every institution's unique. Most retail banks will only let you have their proprietary investments with it. The only exception of the big six is TD, which is interesting because TD for RDSPs, they don't offer them at the retail level at the branch. They only offer them through their direct investing platform, the DIY platform. I personally like that because being in the industry, it's like, I can pick and choose whatever investments I want.
Right.
So TD is unique in that aspect, but most other institutions, credit unions typically have their affiliated investment dealer with it, which is not and that was always a challenge when I was at the credit unions. People were asking me, do you do RDSPs? Yes, we do. But the website didn't say that you do it. That's because the way the credit union system works is the credit unions don't offer them directly. Their securities partner offers them through it, which is a different company name.
Yeah.
But of course, people, they have to explain a lot of this here. But again, depending upon the institution, you might be limited with what you can invest it in because certain firms, again, it all depends on how much money you got. Basically, again, the greater your household portfolio is, that's when they'll usually give you the lower cost investments or the other stuff too. There, usually, if you're going to a retail level bank branch, they're usually going to offer you either GICs or the proprietary mutual funds, which you're going to be paying anywhere between probably on average, 1.25 to 2.5% per year in fees.
Right.
Just for that. So, caveat emptor, do your research. But I always tell people for RDSPs, pick the platform that works, pick the platform that works best for you on a price point that you think is reasonable, based on the level of service that you're looking for. If some people don't want to do online stuff, they want to go into a branch, you might have to pay a bit more going into something like that. Again, it just depends on what you want. It all depends on what. And the same goes with any investment,
right?
Like if any recipe or anything you want to go to at this point, because
you're always better off going to talk to somebody who knows about it because, there's all kinds of things going on that you don't necessarily know about as just a regular person who doesn't work in the industry.
Exactly. Unfortunately, that's often a bit of a challenge when it comes to like with your group retirement stuff, because again, like for example, if you're group RSPs and stuff like that, you're limited to the provider that the employer offers, which is usually an insurance company.
Right.
Although admittedly as well too, there are a lot of the investments that are available in the group retirement plans, they are on average lower than their annual fees are lower than the MERs for a mutual fund at a retail bank branch. And previously in my career, I actually used to sell group retirement plans as well too. So I've sold mutual funds, I've sold seg funds, I've sold insurance policies, I've sold retirement plans. You name it. Apart from options, that's the only thing apart from the only like the fancier derivatives are the only thing I haven't touched in my career. And although I often ask clients as well too there, because one of the things when you're an investment advisor is you have to gauge people's level of investment knowledge. And if someone comes up to me and says, "Oh, what type of, what's your level of investor?" "Oh, I'm a sophisticated investor." And I'm going to ask you, "Okay, what's a naked call?" If you don't know the answer to that one, you're not a sophisticated investor. Yeah. That's basically how an options trade basically works. And if you don't understand options trading, you are not a sophisticated investor.
I have never been anything other than an amateur when it comes to financial stuff.
but most times, most people I know next to nothing. It's usually been most of my experience. Yeah. And let's put it this way: if usually I'm like, okay, if you've got some knowledge, if you know the difference between a stock and a bond, then yeah, you've got some decent knowledge, average knowledge of this.
Sort of, I think. But it's yeah, I don't know. I find that because I've got some debt and I've got I've had to deal with some savings, and this year I hit a deer with my car, and in order to pay off my partner's debts so that we could get a new loan for a new car, I had to withdraw a bunch of money out of my RSPs and TFSA and stuff, and every time I talk to the bank or whoever, they always would say, "Oh, well, they'll usually take X number of dollars or X percent off the top, and then at tax time, you're probably going to get dinged again. So make sure you're." No.
With RSP withdrawals, there is a standard schedule that every institution follows that they have to do it. So, for example, like if you're taking any amount that you're taking out more than $15,000, they have to automatically withhold 30% of that. And
right.
That's just to make sure that a lot of that is to make sure that you don't have that shortfall at the end of the day. You're better off having as much as it sucks providing an interest-free loan to CRA, you're better off having them owe you money than you owing them money.
That's right.
Because CRA is the only creditor in Canada that does not need a court order to freeze your bank account.
Right. And they suck too. They suck to deal with.
Surprisingly, although I haven't had any negative experiences with CRA so far.
Okay.
I will say everyone has their. I've always found times that I've called the CRA for different things. I've had to wait for a while, but I've always found them pleasant to deal with.
Oh, the people on the phone are absolutely pleasant. Absolutely. Yeah. It's usually the rules that screw me over.
Yeah, I've even had a few CRA agents be like, "Yeah, we know the rule. We know the rules are challenging. We know that."
Yeah.
I've always had more issues dealing with Service Canada than CRA.
Yeah.
EI
and that's just going to get worse, actually.
Exactly. Thank you, Mark Carney.
Yeah.
but again, that big, based on, saving goal to there. Another thing also related to credit as well too, there is, unfortunately, in this day and age, credit scores are being used for almost everything.
Yeah.
So you can order your credit score for free from the two major providers, TransUnion and Equifax.
Yeah.
In my experience, Equifax tends to be used more often than not than TransUnion, but you still want to check both.
Yeah.
You can you can sign up for free. You can pay for some more advanced credit monitoring, but you can get your report for free and check some stuff. See what always check to see what free stuff that you can get, because if you'd rather not pay, try to again, in this day and age, everyone's nickel and diming you, right? So,
yep, exactly. I know. Like it was still under Trudeau. There was that. He wanted to introduce the connecting your credit score to rental.
Yeah, so that you can use your rent to build a credit history.
Yeah, which has some potential negative side effects for some people who don't have a great credit score.
And or if you're struggling with income, right? If you're struggling with your rental payment, it's a double-edged sword. And although I find it ironic, people, I mean, while there is much to criticize the People's Republic of China about here as well, too, I find it funny that people are like, oh, what's this whole social credit thing in China about? And I'm like, we have it here. They're called credit scores. The only difference is that it's they're private companies running it. They're private, unaccountable companies running for it.
Private, unaccountable companies. Yeah. Oh my God. I could complain about Equifax all day long.
But again, advice to people out there, check the scores as well too there, because again, if you notice something that is like, what's going on here, you do, there are recourse rights.
Yeah.
Hopefully you live in a jurisdiction where, and because credit scores are typically, because it's property and stuff like that, provincially regulated. If you're having issues, find the appropriate ombudsperson. If you have to, hopefully you might have a relatively friendly MLA that you could connect with as well too there. Hopefully. I've always found in my experience having dealt with government departments, things usually get done faster if you involve your local elected official into it.
Yes, that's true. Yeah.
I've always found that as well too there. As much as elected officials should be doing stuff that they're not doing stuff that they should be doing, but we all know that.
Yeah, we got usually in relation to like immigration, because my partner is she's a permanent resident in Canada, and so whenever she had an issue to deal with for immigration, she would go to our local MP and complain to him. And even though he's like a conservative, like she's a constituent, she lives here, she is part of the people in this area. So he would always look into it, and even like I say, even though he's a conservative, and we might disagree in a variety of ways, he at least tried to do stuff.
Exactly, as well too there, and usually in my case, well too, like my MP here is conservative, but I've dealt with the office there too. They're dealing with EI. Right. And the office was very helpful with it. The office staff was very helpful with it as well too there. And that's a common complaint that people usually go to, is they usually go, they go to the because like I'm having problems dealing with dealing with EI Service Canada. Can you help me out with this?
Yeah.
Sure thing. And their office did help me out on that particular case here. Another circumstance was last year I tried to at some point I tried to apply for AISH because I was going through, having some challenges as well too there. AISH is notoriously difficult to get a hold of. Engage my MLA's office, and they're like, right, we would like to help you. Unfortunately, the AISH rules are just ridiculous. So
jeez.
Basically, like if you like the general, from what anecdotally, from what I've heard for a lot of people that apply for AISH, is they auto reject everyone on the first application. You have to appeal. Because again, government doesn't. They don't want to pay out. But yeah,
nothing can be simple, eh?
Nothing can be simple. I mean, this is exactly why. Until the day happens, we need. This is why. Universal basic income. It is reformist because it's only a stopgap measure.
Yeah.
But still. We've seen studies saying, if you give people money, that's the best way to alleviate poverty and to reduce crime is give people money.
No shit.
No
shit.
No, I know.
Like for people who are on the conservative side of things, who often talk about common sense, like this seems like the most obvious common sense you could ever come up with. I don't need a study to tell me that I'm going to be more productive if I don't have to worry about food on my table.
Oh, and they don't even give people a chance to even do work for themselves basically at this point. Because how many people work for employers that they don't necessarily like working for, but they need it because of the freaking paycheck?
That's right.
They're only there for the paycheck. But of course, you can't really say that, because like any job application, you're like, oh, I'm only here for the paycheck. No, they're not going to go.
I'm literally only here because I'm trading my time for a wage.
Pretty much, right? But again, it's the thing too. Like if you have a guaranteed income, people can do things like they might. Be like, I don't want to report to a boss, basically, right? I'll let me do my own stuff, and then I don't have to worry about financial, ruin or challenges by doing that. So at least I know that I'm getting something coming in. I can pay the the basics, basically, right? So
I
it seems like a common sense, but
in
here's the
yeah,
thing: common sense is not all that common.
right. That's right. In late 2020, I quit my job briefly because of uh, scheduling conflict. And I thought, okay, well, this is my opportunity to really dive into content creation and like really do it and devote time to it. But obviously, I needed income. So I started doing gig apps to just have that income. And in order to make a living doing gig apps, I had to be doing them almost 24 hours a day, 7 days a week, which left no time for the other stuff that I was trying to build.
Unfortunately, yeah. I mean, I've done a few gig apps before as well. I've done a few of them in the past as well too. And yeah, it's a challenge, right? So with the amount of work that you have to put into it, right? So
Yeah.
like with everything here. But
I've heard
that's
that in bigger cities it's better, but in Regina it's you really got to
yeah,
devote the time.
you do have to devote the time for it at this point here. But again, like you said, the reason I started my own independent practice was because again, it's like, again, I'd much rather have I'd much rather be working with my clients directly and have
Yeah.
a practice that aligns with my values as
Right.
opposed to the values of somebody else at this point. And I can, have the flexibility to be like, I mean, granted, when you're independent practitioners all too there, you can be choosy, but you can't really be that choosy because again, you got to have a paycheck, right? But,
Yeah.
we got to earn a living. So, but at the same time too, it's like my practice I specialize in working with, my practice, I specialize working with neurodivergent folks because I'm on the autism spectrum, shared experiences, specialize in working with the LGBTQ community, which I'm also a member of, also specialize in working with like younger professionals, working professionals basically at this point here. For example, I offer a discount if you're an AUPE member, Alberta Union of Public Employees.
Oh yeah.
I offer a discount.
Okay.
I've offered 50% discount if you're a member of AUPE.
Nice.
Yeah, and it's been I'm hoping to expand that to other unions in the future. It has been a bit of a tough nut to crack because oftentimes they have their particular network of providers, and sometimes it's like, oh, who's this random individual trying to come in?
Right. Yeah.
It's like,
Yeah.
and it's like, oh yeah, it's like, I'm well prepared with my pension and everything. I was like, but is the pension going to be enough for all of your rising cost of living?
Right.
Is it going to be enough? What happens if other emergencies happen at this point here? And can you trust whether the person, if you're going to somebody at the bank branch down the road here, the bank branch down the road here, they're an employee of the bank. They put the bank's interest first.
Yeah.
And if you go into that, if you need something from the bank, but if you go into the bank with that mindset, mine's like, sure, they have products and services to offer, but they're for-profit businesses. You know what to expect going into it, right? But who's going to be on my side? And that's where working with an advice-only planner like myself can help out, because my only boss, quote unquote, is my clients.
Nice.
Basically, is your interest. I put your interests. Your interests is your interests come as close as humanly possible. I put them in your best interest. Again, obviously, at the end of the day, I gotta make a living. I have to, put food on my table as well too. There, I know I do have my fee schedule, but at the same time too, it's again, if you can afford my fees, I work to work in as your best interest as best as I humanly as humanly possible here, as opposed to the interests of a bank or an investment firm or whatnot here. It's like, and I can sit down and tell you, here's what you're currently doing, here's what you should be doing, here's what you shouldn't be doing, here's what to look out for, here's what you should consider doing in the future, kind of thing at this point here. Try to take some of the biases out as much as possible. Again, but it is a bit more of a challenge when you're a leftist because the industry does have certain preconceived biases.
For sure.
You have to work around it at this point here, because again, like for example, to some people, to some clients, like, oh, I want to, being like, oh, I wouldn't mind buying an income property at the end of the day, and I'm like, and typically if you are having a rental property, we may not be the best fits for the client relationship at this
Right,
point.
right.
Usually why we have a discovery meeting. We're like, okay, here's an initial introductory meeting. Tell me a bit about your situation. Tell me a bit about your values, what you want to do here. I'll tell you a little bit about what I can do here. And if we mesh, here's my fee schedule. If you want to work, we'll sign a letter of engagement. We can then work together at this point here. And how people can work out all depends on kind of how it works here. So for anyone listening that might be interested here, now caveat, residents of any Canadian province except Quebec only, Canadian province and territory. So you have to be resident except Quebec. And if you go to www.divergentfp.ca, that's DIVERGENTFP.ca. And you can, click on, check that. I am in the process of revamping my website a bit. So, especially as I'm going to be moving to BC within the next little while, moving to, and going forward from there at this point here. But yeah, I'm able to work with folks across Canada, except Quebec. If you think there might be an opportunity for potential to work together, let me know. I don't charge for my, we have a free introductory discovery conversation. Tell me a bit about what you're looking to do, what your circumstances are, what you're hoping to achieve. And kind of we can tell you what I could potentially do for you here. And, we can go from there and see how that could work.
Right on. And I will make sure to put that in the show notes for this as well so that people can find it easy.
Perfect.
Thank you very much for your time.
Thank you very much, Corey. And and it's been a pleasure. It's been a pleasure talking to you there. And it's always, I always find it so great talking a bit about more like just being, it is like there are radical planners out there. There actually was a group that I encountered that I looked into about a year and a half ago to there. I got involved with them a bit, but I kind of stepped back because they were a bit too US focused for my taste at this point here. So, and it was just kind of, so like, but in the Canadian space as well too, it's always it's always a challenge because we have, everyone has their preconceived notions of and it's actually interesting as well too there, especially when you're dealing with especially when you're dealing with queer financial planners, queer financial planners, for financial planner, I can count on one hand, as far as I know, the number of non-cis financial planners out there in Canada, and I'm one of them.
I know one, so you can add one to your tally.
But yeah, and that's always a challenge because most people, and that's always the thing with most people when they're looking in the industry, there's a cis male bias in many cases in the industry. You see a lot of different podcasts and podcasts or industry events or newspaper articles. More often than not, you're seeing cis men. There are more women coming in. There are more women coming out as well too. They're into the industry as well too. There, but it's still an industry. There is still a male dominance in the industry. So it's changing. But again, that's also part of the more liberal kind of like, let's improve diversity in the industry by having more stuff, as opposed to like the industry, again, I'm an anti-capitalist financial planner. I want capitalism to end. So my job for you in the interim here is how do we help you navigate this here as best as we can?
Fair. Yeah, I like that. Yeah, thanks again. I really enjoyed this, and have a good one.
Right. It was great to connect, Corey. You will take care. And thanks to all the viewers and listeners tuning in. Thank you all for tuning in.